Imagine waking up in the morning, looking at your bank account in the next 10 years and seeing it has doubled without you doing no extra work. That's the power of smart investing and personal growth. With the era of AI, wealth has never been more accessible. Companies are sourcing data and information to increase productivity and smart innovations. With the market constantly shifting, one will ask, is investment still a better way to grow long-term financial wealth, or is it too risky? According to Warren Buffett, if you don't find a way to build wealth while you sleep, you're going to work until you die. But let's be real, does any of this actually work, or is it another passing trend? The truth is, success lies in mastering the balance between investing and personal development, growing your financial future while investing in yourself. Now, let's dive into the key steps to kickstart an investment journey today. But before we do that, there are two checklists you must consider before investing. Number one, high interest debt. High interest debt can ruin your finance if not managed properly. Imagine pouring a water into a bucket with a hole. That's what investing feels like when you have a high interest debt. Credit cards from traditional banks carry as high as 15% or more. Payday loan, some go as high as 1,000 APR. But here is the deal. If you're paying more in high interest debt than you're earning on investing, your money is working against you. So first thing first, patch the hole, pay those debts. Next is emergency fund. What will you do if emergency hits tomorrow? According to 2023 survey, 39% of UK adults have less than £1,000 in savings. This is a disaster waiting to happen. Life is unpredictable. Imagine if your car breaks down, a medical bill appears, or a sudden loss of job. Without emergency fund, these situations can lead to debt, financial ruin, or even stress. An emergency fund is your safety net, ensuring that you handle life surprises without relying on credit card or loan. Having 3 to 6 months of living expenses set aside could help you from panic selling your investment when the market dips. Think of it as a safety net before you climb higher. Once you've taken care of these two bodies, let's dive into the first bit. Hi, my name is Francis. I'll be your guide today. So subscribe, like, and comment. Why you should invest? First, let's discuss why investment is essential. Rewind to March 2020, when COVID-19 sent a shocking wave to the world. The S&P 500 and the FTSE 100 plunged to 30% in weeks. This could be a blessing in disguise. But here is what most people don't know. For the past decades, the S&P 500 have realized 160%, while the FTSE 100 have realized 30%. If you would have invested £1,000 in S&P 500 in 2023, would have realized £1,600 in S&P 500 and 1,300 in FTSE 100, and way less in traditional savings accounts where the stock prices have dropped from 15 to 30% over the decades. Our aim is to make passive income. Let our money work for us while we relent on the opulent bed floating castable above crystal clear lake, where 11th Vietnam pours the finest in chartered wine every sunrise, greeting us with richer covers. Yet, we never licked a finger. If that's your dream, the key is investing beats savings, period. The key is to play a long-term game. Investment providers and platforms. Choosing the right platform is very crucial. There are so many platforms such as the Hans Grave Lansdowne, who have the AJ Bell, who have the Vanguard, but one top recommendation is Trading 212, and here is why. They are beginner friendly, commission free, and they offer fractional shares so that you can start small. Start today with just £1 and get free stock worth up to £100. Link in the description. So where should you put your money? Let's break it down. There are two types of savings in this category. One will have the private pension, and will have the stock and shares ISA. Private pension. This is a type of account set aside by an individual or their employer, which is separate from the state pension provided by the government. This is a fast, efficient way to save and invest for retirement, with access to funds at the age 55 and is rising to 57 in 2028. Average pension pot in the UK at the age 65 is around 190,000, but this varies wide. For migrants who arrive in the UK later in life, building a sustainable private pension might not be the most effective route for them. Our philosophy is simple: retire before you retire to enjoy life. That is why we won't be discussing private pension in today's video. Rather, we'll focus on alternative ways to build wealth and enjoy financial freedom at our own terms. That brings me to stock and shares ISA. Feeling overwhelmed? Don't worry. You don't need to be a stock picking genius. The easiest way to invest is through index fund, that's exchange traded fund. The S&P 500, which comprises of the top US companies. I'll have the FTSE 100, which comprises of the top UK companies. These two index funds are most attractive because of its low cost and the diversification, and they are historically strong. Another fund in our list is the Global Index Fund. The Global Index Fund tracks the broad market index across multiple countries, offering a diversified exposure to the global stocks. Here are some well-known examples of the global index funds. While the Vanguard FTSE All World UCTIS ETF with the ticker VWRL, while the Fidelity Index World Fund will have the L&G Global Equity with the ticker LGGL, or have the Investico FTSE All World with the ticker FWRD, or have the iShares MSCI ACWI UCITS ETF with the ticker SSAC, and many more. Just remember, you don't need to know anything or do any market research to start your investment journey. All you need is to diversify your investments or portfolio into global index fund or the ETF, which have returned about 8 to 10% yield. When you're familiar with the platform and the process, you can decide to check some investment, or you can decide to diversify in some individual stocks, like have the Amazon, have the Tesla, there's the Nvidia, and a whole lot of them. Remember, capital is at risk, so trade safely. Pitfalls to avoid. Here are some common mistakes to avoid. Imagine this scenario. In the late 2019, I had a job as a production assistant in the UK. I decided to invest in stocks and currency trading for the first time. After a few months of research, I bought the stocks worth £3,500 and I invested $500 into currency trading. I was excited, hoping that this is the start of my journey to financial freedom. Then March 2020 hits. The COVID-19 sent a shocking wave through the global market. The stock market plummeted as I watched in horror and panic as the stock dropped to 40% in just few weeks. Fear took over me. Every news channel was screaming recession, market crash. I was convinced that if I didn't sell that stock, I'm going to lose everything. As a beginner investor who lost his 4 months worth of savings in just few weeks, I sold the shares, taking a loss of £1,900. Fast forward to 2021, the same tech company rebounds and reached an all-time highs, doubling its pre-COVID pandemic value. I sat down in tears and regret. Why didn't I hold the shares? What was my offense? I went into the market with this get-rich-quick syndrome. I wanted an immediate gain from the market, which backfired, putting me into panic selling my shares when the market dips. The lesson here is simple. Investing takes time. You need to be willing to play a long-term game. You can leverage the dollar coaster strategy. The perfect time to invest is today. Learn the golden rule of investing. Stay calm and think long-term. The last but not the least is investing in yourself. Investing isn't just about stock. It's about you. Studies shows that employers who invest in employees' training sees about 24% in profit margins. Why? Because skills, connection, and knowledge pays off. But you need to embrace reality. Change your thoughts and habits. According to local news, there has been a breakout between Habit Loop and Habit Hustle, which have massively rewarded personal growth, as outlined by James Clear in Atomic Habits. To help your development process, steps like courses and certification makes you stay ahead in your career. Books and learning makes knowledge compounds just like money. Networking and mentorship. Your network is your net worth. Health and productivity. More energy, better decisions. Remember, your biggest wealth-building tools is not stocks, nor crypto. It's you. The more valuable it becomes, the more money follows. So are you ready to take control of your financial future? Start investing today. Use my Trading 212 link for free starts. Commit to self-growth. Pick a book, a course, or a skill. Like and subscribe. Let's grow together. I'll see you in the next video. Much love.